Hello everybody, I hope you're ready for some more exciting inventory method discussions. So, how does management choose which inventory method they want to use? Well, the reality is it's not whether they sell milk or dirt that determines which method they use. They really consider the income effects and the income tax effects. Managers obviously prefer to report higher earnings and pay the least amount of taxes as possible. So in an ideal world, management would generally use FIFO because remember, prices generally go up because of inflation. And in a period of rising prices, our little example, 1 at 5, 1 at 6, and 1 at 7, FIFO is going to give you the lowest cost of goods sold. LIFO gives you the highest, and average goes in the middle. So in a period of rising prices, which generally is what we have because of inflation, managers are going to want to choose FIFO because it gives us the lowest cost of goods sold, which in turn gives us the highest income. However, from an income tax perspective, managers would rather choose LIFO because it lowers the income. Higher expense means lower income and therefore lower taxes. You'd like to choose one method for accounting and another for taxes. However, the IRS is on to you, and they have said that if you want to use LIFO for taxes to get the benefit of the tax savings, you also have to use LIFO for book purposes, and that's called the LIFO conformity rule. So the IRS won't let you have your cake and eat it too. So if you want to show high income for the shareholders on your financial statements using FIFO, you have to use FIFO for tax purposes. If you use LIFO for tax purposes, then you can use LIFO for book purposes as well. But you can't use one for book and one for tax. The IRS doesn't allow that. Managers can sometimes choose an inventory method to make themselves look good. As you've already seen, the selection of the inventory method can have a big impact on the bottom line of a company. So during a period of rising prices, LIFO is in the best interest of owners because it reduces the tax liability, but managers might want to use FIFO because it results in higher profits and potentially a higher bonus for them. Is that ethical? Probably not, but it's not going to stop managers from doing it, which is why it's important to have the board of directors heavily involved because they're supposed to oversee managers and make sure that they're working in the best interest of the owners. Now we're going to talk about recording our inventory at the lower of cost or net realizable value. Inventories are originally recorded at what we pay for them. When the net realizable value of the goods falls below the cost, then we need to reduce the cost of our inventory. The rule that requires this is known as the lower of cost or net realizable value, which is the lower of cost or market rule. What does this mean? It means we need to record our inventory at the lower of cost or its net realizable value, which is the selling price minus any cost to sell. For example, if we give a commission. This is based on the conservatism principle, which says we want to make our company be as conservative as possible, which means record any potential losses right away to show the worst case scenario to the owners. Obviously, managers don't want to do that, but this is what GAAP requires. Companies that are particularly susceptible to this would be high-tech companies or any company that sells seasonal goods. With high-tech companies, the example I always give in class, and it depresses me more and more every year, is I ask how many of you know what a floppy disk is? And a couple people raise their hands and say, oh yeah, I know what it is. And then I ask, well, have you ever seen one? And a few people raise their hands. Then I ask if you've seen like a 5 1/4 inch one, which is the oldest type of floppy disk. Many people haven't seen that. You've seen, I think it's a 3 1/2 inch like plastic coated one. Bottom line is none of us, including myself, ever use floppy disks anymore. We might use flash memory, but frankly, most of us don't even use that. We use the cloud. So what's the point? The point is, as technology changes, older technology becomes obsolete and is useless. It has no value. So if we have a whole bunch of that older inventory on hand, we need to consider the fact that it may not be sellable anymore, meaning we're not going to be able to sell it. So we need to record the loss on that old inventory now. We don't want to wait, because the conservatism principle says we need to record our inventory at the lower of the cost we paid for it or what it's worth today. Companies that sell seasonal goods often have the same issue, because once the season is over, if it's like the camping season, once the camping season's over, nobody's buying those goods anymore until the next season. So the market value of those goods goes down. How do we deal with it? Well, it's very easy. Basically, all you have to do is compare the cost of the goods to the net realizable value, which is the selling price less any selling costs. And if the cost is a lower number, you don't have to do a damn thing, because the rule is lower of cost or market. It's already recorded at cost, so nothing needs to be done. If the market is the lower number, then you have a problem and you need to record a loss. So let's look at an example. We have HP and they have some Intel chips and disk drives. You notice for the Intel chips, the cost for the item is $250 and the net realizable value is $200, so the net realizable value is lower. So we have a problem. Disk drives, on the other hand, the cost is $100 and the net realizable value is $110, so the cost is already the lower number and nothing needs to be done. So what do we have to do? Well, for the Intel chips, we need to record the loss. And there's a variety of ways we could calculate it. I'm going to show you the way I would do it. I basically would say, well, the cost is $250 for each, and we could sell it for $200. So $250 minus $200 gives me a loss of $50 a pop, and we have 1,000 of them. So that's going to give me a $50,000 loss. How do we record it? Well, whenever we use up inventory, we record it as cost of goods sold. So our cost of goods sold would go up for that $50,000, the value that the inventory has decreased by, and our inventory asset will go down by that same amount. The effect on our accounting equation, just as a reminder, we don't think in debits and credits, we think in terms of up and down. Expense go up, which makes net income and equity go down, and then our assets go down, balancing out the accounting equation. Again, because the disk drive's cost is already the lowest number, we don't have an issue and we don't need to make any adjustment for the disk drives. It's only the Intel chips, because their net realizable value is lower than the cost, that we need to make a lower cost or market adjustment. Obviously, inventory has a higher chance of having a lower of cost or market issue the longer we hold on to it, because the longer we hold on to it, the higher the chance it becomes obsolete. To determine how quickly a company sells their inventory, we could calculate inventory turnover. This is similar to our accounts receivable turnover, which was a measure of how quickly we collect our receivables. Inventory turnover is a measure of how quickly we sell our inventory. It's cost of goods sold over average inventory, where average is beginning plus end over 2. The higher this is, the better, because it means we're able to fill up and empty out our warehouse more times during the year. If we had an inventory turnover ratio of 8, that would mean we are able to fill up and empty the warehouse 8 times per year. Now, realistically, we don't fill it to the brim and then empty it down to 0, but it is a measure of how many times we could do that during a year. Is 8 good? I don't friggin' know. I need something to compare it to. All of our ratios, we need something to compare it to. So 8's good compared to 7, but 8's not good compared to 10. So you need something to compare it to, whether it be the prior year number for the same company or looking at competitors in the industry. To better understand it, like I told you with the receivable turnover, we can convert it to days by taking 365 and dividing it by the inventory turnover. We want this to be lower. So if our inventory turnover is higher, that means our denominator is higher, which makes the days to sell lower. The lower it is, the better, because this is the average number of days it takes to sell our inventory. The quicker we sell it, the better off we are as a company, because it allows us to convert that inventory to cash, number one, which can be used elsewhere, and it reduces the chance that the inventory will be obsolete, and it reduces our holding costs, the cost to keep that inventory on hand in our warehouse.